Welcome to Quick Course Digest. Today, we're going to crack open the world of managerial accounting. So, how do the best managers do it? How do they seem to just know the right call to make? Whether they're setting prices, launching something new, or trying to make things run smoother. It can feel like they've got some kind of sixth sense. But I'll tell you, it's not magic. What they really have is a powerful internal toolkit.
And that toolkit?
Well, that's managerial accounting. Now, this isn't the kind of accounting you're thinking of. It's not for the tax man or for Wall Street. This is the accounting that's made for managers, for people inside the business, to help make smarter decisions. All right, so let's open up this toolkit and see what's inside. First, we'll talk about what it's really for, its core purpose. Then we'll get into the nitty-gritty of costs. After that, we'll map out a financial roadmap with budgeting, see how to track costs while we're actually making stuff, and then figure out how to grade our own performance. And finally, we'll see how all of this helps us make those big strategic calls and make them ethically. Okay, first things first. What's the point of all this? Really, you can think of managerial accounting as the company's internal compass. It's the thing that keeps everyone and everything pointed in the right direction. So the textbook definition really nails it. It's all about getting the right information to managers inside the company. This is the key difference, right? Financial accounting is for outsiders, investors, banks. It's all standardized. Managerial accounting, it's the complete opposite. It's custom builds, it's for internal eyes only, and it's all about giving you the intel you need to plan, control, and make better decisions. All right, now for the most basic tools in the kit, costs. We gotta understand our costs, because if we don't get this part right, pretty much everything else we do is built on a shaky foundation. So first up, we've got product costs. Think of these as any cost that you can logically attach to the thing you're making. So if you're baking cookies, it's the flour, the sugar, the salary for the baker who mixed the dough, even the electricity that ran the oven. And here's the cool part. These costs are inventoriable. That's a fancy way of saying they actually become an asset called inventory on your books until you sell that cookie. Then on the flip side, you've got period costs. These are all the other costs you need to just keep the lights on and run the business, but they aren't tied to making one specific product. We're talking about things like your marketing budget, commissions for your sales team, or the rent on your main office. These don't hang around as inventory, they just hit your income statement as an expense right away, in the period they happened. And here's where it all comes together. You've got product costs to create a product and period costs to run the business. One goes on the balance sheet as inventory, the other goes straight to the income statement. So, why does this matter so much? Well, imagine a customer wants a special one-time order at a discount. You absolutely need to know if that discounted price at least covers your direct product costs. The example of electricity is perfect. Power for the factory floor is a product cost. Power for the sales office? That's a period cost. It's the same bill from the power company, but how you classify it changes everything. Okay, so now that we have a handle on our costs, let's pull out the first big power tool from our kit, the budget. You can think of this as the financial blueprint, the architectural plan for the entire company. You see, the master budget isn't just one document. It's more like a set of dominoes. And the first domino to fall is always the sales budget. Your sales forecast, how much you think you're going to sell, kicks off the whole process. That tells you how much you need to produce, which is your production budget. From there, you can figure out your budgets for materials, labor, and all your overhead. And all of that feeds into the one everyone watches like a hawk, the cash budget, making sure you don't run out of money. The grand finale? You get these projected financial statements that show you what the business will look like if everything goes according to plan. And here's something people often forget about budgets. They really have two critical jobs. Job one is planning, right? It forces everyone to think ahead and decide where to put the company's money. But job number two, which is just as important, is control. After the quarter is over, that budget becomes your measuring stick. It's the benchmark you use to see how you actually did. And it helps make sure the whole team is rowing in the same direction. And this really highlights why that cash budget is so important. Just because you make a sale doesn't mean you have the cash in hand. For example, let's say you log $15,000 in sales in the first quarter. Great, but you might only collect 60% of that, say $9,000, in that same quarter. The other 40%, that's $6,000, might not show up until Q2. And that little timing gap, that's the kind of thing that can get a business in real trouble if you're not planning for it with a solid cash budget. All right, the plan is set. The blueprint is done. Now let's head out onto the factory floor. How do we keep track of all these costs while the gears are turning and we're actually making our product? Well, for businesses that churn out tons of identical products, like, say, our cookie factory, we use a method called process costing. The whole idea is pretty simple, actually. Costs just flow along with the product from one department to the next. And each one of those departments has its own little bucket, an account called work in process or WIP, to hold those costs. And you can just picture the journey, right? The cookie dough starts in the prep department, and all the costs of the flour and sugar get tossed into prep's WIP account. Then, as that dough moves to the ovens, the costs get transferred over to the baking department's WIP account. And again, when they get packaged, the costs literally follow the cookies down the line. And this isn't just for fun. It lets a manager pinpoint exactly where money is being spent, which is crucial for controlling expenses and figuring out the true cost of a finished cookie. So, production is humming along, we're tracking costs, but are we doing a good job? Are we on track? How do we know? Well, it's time to pull out the managerial report card and see how we're doing. Okay, let's say your original plan, your static budget, was based on having 10,000 customers. But then you have a great month and 12,000 customers show up. If you try to compare your actual spending to that old static budget, it's totally unfair, right? It's a classic apples to oranges comparison. That's exactly why we have the flexible budget. It's a much smarter tool that adjusts the budget to match what actually happened, giving you a fair and meaningful comparison. Let's stick with that idea. Maybe we're running a movie theater. Our flexible budget looks at the 12,000 actual customers we had and says, okay, based on that, your popcorn cost should have been about $3,000. That right there, that's our new, much more useful benchmark. But then we go and count up the receipts, and we find out we actually spent $3,200. That extra $200, that's what accountants call an unfavorable spending variance. And unfavorable is the right word, because we spent more than our adjusted plan said we should have. Now, the point here isn't to blame someone. That variance is just a signal. It's a red flag that tells a manager, hey, look over here. You need to investigate why it happened. Maybe the price of kernels went up, or maybe there was some waste. This whole idea is called management by exception. You don't worry about what's going right. You focus your purchase time on the things that are off track. Okay, last but not least, let's talk about the big picture. What tools do managers use for those massive, company-shaping decisions? This is about choosing where the ship is heading for the long haul and doing it with both sharp financial tools and a strong moral compass. So when you're thinking about, say, building a whole new factory, you're going to use heavy-duty tools like net present value, or NPV, and internal rate of return, or IRR. They sound complicated, but the ideas are pretty straightforward. NPV basically asks, in today's dollars, will this project make us more money than our investors expect? If the answer is a positive number, you're good to go. IRR, on the other hand, asks a slightly different question. What is the exact percentage return this project is giving us? And that's super useful when you're trying to compare a few different projects to see which one gives you the most bang for your buck. But look, the numbers can't be the only thing that matters. The truly great managers know that you have to filter every big decision through some core ethical principles. That means being transparent, so everyone knows why a decision was made. It means taking responsibility for the outcome, whether it's good or bad. And it means having empathy, thinking about how your choices affect actual human beings, from your employees to your customers. And let me be clear, this isn't just some fluffy feel-good stuff. This is absolutely critical for building trust and a business that's meant to last. And this quote just ties it all together perfectly. Good decision-making is rarely done by intuition. Consistently good decisions result from diligent accumulation and evaluation of information. That's what managerial accounting is all about, right? It's not about guessing. It's about building a system to get the right information so you can make the right call time and time again. That's the real power of this toolkit. Which brings us to one final, really interesting question to chew on. As AI and machine learning get better and better at crunching all this data for us, what's left for the human manager to do? When the analysis is instant and perfect, what becomes the truly essential skill? What is it that we bring to the table? Something to think about. That's all for this explainer.